Today in managerial accounting, we're looking at operating leverage. Operating leverage refers to how sensitive a company is to changes in volume. To determine operating leverage, we take contribution margin divided by operating income. When fixed costs are high relative to variable costs, operating leverage is also high. This results in more extreme highs and lows in operating income. When fixed costs are low relative to variable costs, operating leverage is also low. This results in less extreme highs and lows in operating income. Let's take a look at an example. Level Up Gaming gives the following information to determine the operating leverage for 2 different years. Which year would a 5% increase in sales have a larger impact on operating income? Here we have year 1 and year 2. In year 1, the sales were $425,000. The variable costs are $145,000, giving us a contribution margin of $280,000. Fixed costs are $105,000, and operating income is $175,000. To determine the operating leverage, we will take contribution margin divided by operating income. So $280,000 divided by $175,000. This results in an operating leverage for year 1 of 1.60. In year 2, sales is $300,000. Variable costs are $105,000, giving us a contribution margin of $195,000. Fixed costs are $75,000, giving us an operating income of $120,000. To determine the operating leverage for this one, we will take again contribution margin divided by operating income, or $195,000 divided by $120,000. This gives us an operating leverage of 1.63. Now to determine the change in operating income, we take the percent change in sales times operating leverage for each year. So for year 1, we take 5% increase in sales times the operating leverage of 1.60. This gives us an 8% change in operating income. For year 2, we take the 5% increase in sales times the operating leverage of 1.63. This gives us a change in operating income of 8.15%, which shows that year 2, a 5% increase in sales would have a larger impact on operating income due to the operating leverage.